What's happening, my beautiful legacy builders in training? Welcome back to another episode of the Do.Different.Better Show, where we talk wealth wisdom, money moves, and making finance simple for everyday people. I'm your host, Elaine Rasmussen, CEO and founder of Social Impact Now, Connect Up Institute, and managing director of the Integrated Capital Fund. This episode is the second installment of a two-part series on the Big Beautiful Bill, or OBBBA as I like to call it. And if you missed part one, go back and take a listen. It's going to be a good grounding, but you don't have to. You can take this one in first. I talked about the good, the bad, and yes, some of the ugly aspects of the bill. And now, today, we're going to kick it off by talking about the ugly loopholes, landmines, and corporate candy, the hidden goodies for people and corporations who already know how to work the system. These are the provisions that sound harmless and or even helpful until you maybe start to see who actually gets to cash in on these opportunities. So, first, we're going to get into, once again, I just want to give you a little bit of background. So the Big Beautiful Bill was signed into law on July 4th of 2025. It is sort of quasi what some people would call like an omnibus bill or very large scoping, overreaching bill that really specifically impacts the tax code as well as some larger economic impacts of how the governments are going to work. So, some spending cuts, some tax policies changes, some significant tax policy changes, and that will have some large sweeping economic impact. And again, as I talked about in episode one, this bill will touch every single human in the United States in one form or another, whether you're a poor family living in rural America, or you're a wealthy CEO, or you're a millionaire or billionaire with multiple companies. So no matter who you are, doesn't matter what your tax status is, doesn't matter what your social economic class, it doesn't matter where you live, this bill is one of these rare occasions that is actually going to touch every single person in the United States. So, and I don't say that casually. I would not say that. I would say that most national bills maybe peripherally will touch you, but this bill in particularly will absolutely touch every single person who files taxes. I'll put it to you that way. So first, let's get into the corporate candy, and there's a few that are very, very specific. So the first one I'm going to talk about is the extension of the 20% pass through deduction. This is a big one to start with. The extension of the 20% pass through deduction for qualified business income, or QBI. If you own a pass through business like an LLC, an S Corp, or a partnership, you might qualify to deduct up to 20% of that income from your taxable earnings. From your taxable earnings. So, on paper, that sounds like a big win for small businesses. But I'm going to keep it 100. There is a twist. This deduction heavily favors people with high incomes and certain industries like real estate. Folks like commercial landlords and real estate developers are in the prime position to maximize this, while many everyday business owners get phased out or won't be able to meet the qualifications. So, this is something you're definitely going to want to talk to your accountant, more likely your CPA. Your accountant is actually going to process your finances, right? So your accounts receivable, your accounts payables. Your CPA is the one who files your taxes. Typically, an accountant may or may not be a CPA. You would have to have a CPA to have that qualified person to file your taxes. That's not to say that an accountant can't file your taxes, but a CPA, which stands for certified, I always forget what the P stands for. Oh, certified. Oh, I can't remember. It just left me. But a certified accountant, which is somebody who can actually file your taxes, and they're going to have a higher level of knowledge because they're going to know the pieces of the tax code. Certified public accountant. That's what it was. I couldn't remember. But a CPA is a certified public accountant, which means they have passed and been certified that they are able to file your taxes with um, a certain level of expertise, right? So this is what you want. This is what you want to have be somebody walk you through or talk you through how can your small business benefit, if at all. They're going to be able to tell you, hey, you're not going to be able to qualify for this particular deduction. So while on the face of it, it sounds like, oh, this is a great thing for all businesses, it's not for all businesses. So you definitely want to check and find out if this is a tax opportunity that you qualify for. So moving on to corporate candy number 2, bigger estate and gift tax exemption. The OBBB would increase the estate and gift tax exemption, the amount of wealth you can pass on without paying federal taxes, paying federal estate taxes. So, for wealthy families, this is a huge tool for protecting intergenerational wealth. If you've got millions in assets, you can pass down far more of it tax free. For the rest of us, it's not really relevant or meaningful. Most families will never hit the current exemption threshold, let alone the expanded one. But here's why it matters. This move keeps even more wealth concentrated at the top, which widens the wealth gap, especially between racial and rural communities that haven't had the same chance to build that kind of asset base, right? So, again, you really want to think about, is this something that you actually can qualify for, right? You may be thinking, like, how much do I have to be able to pass on? What does that mean? What does that look like? And can I qualify? Right now, there are some opportunities for folks that are in the lower tax bracket. But once again, leveraging this as a mechanism to be able to pass money down or pass assets down to your children or grandchildren is going to be huge. One of the reasons why this is so key and important at this moment is because of the age of where the baby boomers are. Many baby boomers are already past retirement. We are going to see a wave of mortality in our economy just by the nature of the baby boomers having such a large disproportionate amount of the population, right? What comes with that? I'm sorry to say this out loud, but death comes with that. So there's this tax opportunity is really thinking about what's going to be happening to that wealth and how it will be passed down and maintained, which goes back to my earlier point about this has a huge impact as far as widening the wealth gap and economic gap within our community between the people who have the least and the people who have the most. Corporate candy number 3. So, business friendly policies without equity guarantees. So, I talked about in the first episode about opportunity zones and what opportunity zones are. If you don't know what opportunity zones are, go ahead and listen to that. But I might do a follow-up episode that's just specifically on opportunity zones because I don't think we've talked about that on the show. So, opportunity zone reforms could open up more areas for investment, but the bill doesn't require equity guarantees. This means investors aren't obligated to ensure the benefits stay in the community. We could see shiny new developments, but also rising rents, local displacement, and locals that are locked out of any economic gains. A lot of times these developers that are coming into the communities aren't from the community. They're not even from the state. We have seen, I will just tell you, in Minnesota, a lot of money come into our state for developments that have come from the coast. And so that money then leaves the community All the money that's made from the development leaves the community because people spend money where they live and work, right? But if you don't live and work in that community, you're far less likely to spend the money. Now, obviously, if you are in a development that has mixed use, there are restaurants and things like that that will benefit from the community. But the larger investment dollars or the return on investment dollars that come from that development, more than likely, in part or in whole, will leave that state or and leave that particular community. So, corporate candy number 4, reduced IRS enforcement and IRA funding repeal. This one doesn't sound exciting, but it's also a big deal. The OBBB proposes cutting IRS enforcement and repealing funding from the Inflation Reduction Act, which is meant to modernize the tax enforcement. When the IRS has fewer resources, it audits fewer wealthy individuals and complex corporations because these audits take time and expertise. Instead, enforcement tends to fall harder on low and middle income taxpayer where audits are cheaper and faster to run and far more predictable because usually people who are in a particular economic class usually do the same sorts of things. They have the same sort of deductions, they have the same sort of filing, they have the same sort of demographic makeup. And so we may see, I'm not saying that this is going to happen, but we may see a rise in audits on folks who are on the lower end of the economic scale. And who they all will tend to look very, very similar, right? So people who are opponents of the bill say this is a run on poor people. This is a run on lower economic people. I think once again, the proof is going to be in the pudding. What actually happens and what's being enforced and what's not going to be enforced is that's what's going to tell the tale whether or not this turns out to be a good thing or a not so good thing and who is actually going to be impacted. Um, and seeing that there has been a pullback from the government on white collar crime, investigations on white collar crime, tends to make me believe that the disproportionate amount of energy of the IRS in doing audits is going to be targeted towards simpler, faster audits, which means we're talking about people who are doing 1040 EZs, 1040s, who don't maybe have a lot of schedules, which we know tend to be people who are going to be on the lower end of the economic scale. Now, corporate candy number 5, enhanced benefits for large foundations, private equity, and family offices. And if you don't know what any of those words mean, I've done episodes on each one of those. I've done an episode on private equity. I'm not sure if I've done an episode on family offices. And if I haven't, I will. And that way you can understand what family offices are. But I know I've talked about them in a couple of other episodes. So just do a search for family office and a video that I've talked about it on will pop up. Um, so these are also sweeteners for big philanthropic foundations, private equity firms, and family offices that are mining the investments for or managing the investments of a particular family. It could be a multifamily, it could be a single family. These are things like extended deduction carry forwards, looser rules on certain investments, and easier ways to shelter executive compensation. This is high level wealth strategy, not something your average Main Street business owner can access. It does not involve you. The thresholds, once again, what did I say what a small business is? 7.5 million in revenue or less and 50 employees or less. So when we talk about family offices or private equity, unless you are actively investing in those and you have your own family office, yes, then it may influence you or impact you positively. But if you're not in any of those tax brackets or socioeconomic class, this one probably is not going to touch you, right? So now let's talk about the loophole watch. If you're wondering how this is actually going to play out in real life, here are a few to keep an eye on. So, one, deduction stacking. That is combining multiple deductions to zero out taxable income. Opportunity zone carve outs, structuring deals to get the tax benefits without truly benefiting the local community. Executive compensation shelters, moving bonuses and stock options through structures that reduce or defer taxes. For everyday taxpayers, these really aren't on your financial strategy menu. But for corporations and wealthy families with sharp accountants, it is a buffet. So, what are some of the takeaways from this segment? The OBBB doesn't just change the rules, it builds in advantages for those already playing at a super high level. And while some of these tools are technically available to everyone, they require the kind of money and advisors and connections that many people just do not have. That's why policies like this can widen the wealth gap and why rural and working class communities, no matter their political leaning, often get left with the crumbs. So I just want you to be mindful of when you hear all of this, more than likely it's not going to pertain to you and you're not going to be able to benefit because you're not going to be able to meet the threshold, right? We're talking probably about the top 20% of the top 20th percentile of Americans in the United States. Now, coming up in segment 5, I'm going to be bringing it down to the ground level. What all of this means for you. We're talking about how this bill plays out for our communities. So, poor families, no matter what your ethnic background is, small businesses, gig workers, and even folks with disability savings accounts, because policy isn't real until we see how it impacts our real lives. So I want you to stay with me. We'll be right back when I show you how to do different better with the OBBB. Welcome back to the Do Different Better Show. I'm your host, Elaine Rasmussen. And in this segment, we're talking everything we've talked about so far, the good, the bad, the ugly. And now we're going to bring it down to where you live. Because all the tax talk and policy language doesn't mean much until we actually see how it plays out in real life. So let's talk about who this bill actually helps, who it leaves behind, and what ripple effects might be for you, your family, and your business. So let's start at the top. People who look like me. Historically, big federal economic policies have a track record, and it's not great when it comes to racial equity. This bill could have mixed effects. So, first, let's talk about home ownership. If you already own a property, extended tax cuts might help with overall affordability. But again, with opportunity zone expansions, without strong equity protections, could speed up gentrification in historically poor Black and Brown neighborhoods, driving up housing costs for current residents and pushing them out to the peripheries of our communities. Next, there's access to credit. More small business deductions might help entrepreneurs, but without direct reforms to lending, many people, particularly rural based businesses, once again, no matter what color you are, Black and Brown owned businesses and women businesses still face systemic issues with getting great capital or quality capital without high prices. Next, wages. While the bill emphasizes tax relief, it doesn't directly address wage stagnation, which is a key driver of wealth gaps, right? And it's not really addressing financial mobility of actually how do you actually, if you start a low paying job, how do you move your financial mobility up to a higher wage job? It doesn't matter whether is a blue collar job or a white collar job, but there's nothing that really addresses moving people into higher tax brackets. So let's look at poor white workers, especially working in rural areas. For rural communities, there are some wins like broadband expansion, which I talked about in segment one, manufacturing incentives, and infrastructure upgrades. These can create jobs and improve access to resources. But here's the catch that I want you to be aware of. Without an investment in workforce training and public infrastructure like affordable childcare, reliable transportation, these jobs might be hard for local residents to take or keep. And if new industries bring in outside workers, local folks can be left struggling. So what does that look like? What that looks like is you've got this great company or this great manufacturing company that is, or infrastructure company that has come in. And because nobody in the community is trained on how to do those jobs, or maybe a very small portion of them are trained on how to do this job, the labor will come from outside of the community. And what we know about what happens when labor comes from outside the community, again, I talked about it in segment one, that dollar is going to be spent in another community. Some of it might be spent at the local restaurant or, the local, grocery store, but the dollar will not circulate within that community. So these are things that you want to think about and how they might impact your community and keeping dollars spent in the community. Now let's talk about small business. If your business is structured to benefit from pass-through deductions like an LLC or an S corp, and you're profitable enough to invest in equipment or property, this bill could give you a tax boost. But if you're a micro business, and remember I talked about what a micro business is, or a sole proprietor, or operating as a gig worker without a formal business structure, most of these benefits won't reach you. You might still face the same cash flow challenges without the tax saving the big players actually get. So, this is one of those things where if you've been trying to operate under the radar and you've operating a cash business, this is the time for you to think about actually legitimizing your business, getting an EIN number, getting registered with your state, registering your business with the state, because it is only then that you can not only take advantage of the tax benefits, but you can also start to take advantage of some of the programming that's available through your local state, whether that be grants, whether that be technical assistance, whether that be some other kinds of opportunities around. Like I know in the state of Minnesota, we have a pool of funds that helps with if you've got employees that are neurodivergent and maybe they need some extra accommodations. Our state has money that small businesses can apply for to buy those, that help them buy those things for those employees, so that the economic expenditure isn't on entirely on the business. You aren't able to take advantage of those things unless you're registered as a legitimate business with your state. So this could be the prompting that you may want to leverage to be able to get your side hustle actually legitimately up and going because of the tax benefits. So here is a real case example. Thinking about gig and tipped workers. You might get some tax relief if your income falls into the extended lower brackets. But without benefits like paid leave, healthcare, or retirement contributions, your long term financial picture doesn't change much. Disabled adults using ABLE accounts or ABLE accounts, there are some modest gains, possibly higher contribution limits and better tax treatment. But the reach is limited. Not everyone's going to qualify, and the benefits are capped. So now moving on to Main Street versus Wall Street. Main Street business owners might see some simplicity in deductions, but Wall Street investors and high net worth families will still have the advantage of wealth strategies that multiply their savings, which then allows them to make other investments and take their investment returns into and tripling and doubling down on those opportunities. So the other thing that is really important for us to for you to think about, particularly as it relates to tipped workers. So one thing that's important for you to understand, not only as an employer but as a tipped worker, what's outlined in the bill is you the bill, the way that it's been marketed is that the bill, there's no taxes on tips. That's not entirely true. The way that it works is, and for time and a half workers, that the time and a half isn't going to be taxed. That's not entirely true. The way that it's going to work, and I just actually got certified in this literally yesterday, the way that it works is for tipped workers. Well, let me talk about overtime, or time and a half, I should say. You're not going to be taxed on the half of the time and a half. So let's say you work 40 hours, right? You're going to be taxed at your regular base for those 40 hours. Let's say you have 10 hours of time and a half pay. You're still going to be taxed, which means equates to 15 hours, right? You work 10, but you're going to be paid for 15, right? It's time and a half, right? You're going to be taxed at your regular tax rate for the 10 hours. The extra 5 hours that you're going to be paid will not be taxed, right? So out of the 15 hours that you work 10 hours, you're getting paid for 15 hours, you're going to be taxed on the 5. I mean, sorry, you're not going to be taxed on the 5 hours, right? So let's talk about dollars and cents. Let's say you are getting paid $10 an hour. I know that's ridiculous, but we're going to keep the math simple, right? You're going to be paid $10 an hour. You work 40 hours, that's $400. You worked another 10 hours at time and a half. So what does that equate to? That is going to be $10 times 15 hours, because you're getting paid time and a half. So you're getting paid for 15 hours. That's $150. You are going to be taxed on 100 of that $150, and you're not going to be taxed on the 50 of that $150. So I hope that you understand that that's how that no tax on tips is going to work. Not, and especially now, because many organizations, many businesses provide their tips through the payroll system, right? So unless you are getting cash tips, if your tips are being calculated by your employer, because let's say at a restaurant, I'm putting my tip on the actual bill, that means it's going through the employer, which means your pay is going to come through your payroll, right? That is how that money is going to be taxed. You are still going to be taxed. You're just not going to be taxed on that 50%, or that when you say time and a half, on the half. You're not taxed on the half, but everything up until that time, you are going to be taxed at your regular tax rate. So this might be the time when you want to think about increasing your HSA, increasing if you have a IRA, or I'm sorry, if you have a 401k or a flex savings account, a health savings account, any of the things that will mitigate your taxable income. This might be the time you want to increase those, so that you can get some savings if you know that you are going to be doing a lot of time and a half working. I remember working in retail, I often would be doing time and a half because of certain times of the year. Maybe it's a sale, maybe it's inventory, maybe it's the holidays. You know that you're going to be earning this extra money. So you want to be taxed as little as possible, because you know what you're going to do with that extra money. You're going to put it into some kind of savings or investment, right? So the more that we have to make these investments, the better the off you're going to be. So I want to now kind of wrap this segment up and give you some key takeaways. This bill's impact depends heavily on where you live, what you earn, and how your financial life is structured. If you're in a zip code with a strong infrastructure, meaning access to capital and a thriving economy, local economy, you may actually see some real gains from OBBBA. If you're in a community that is already struggling with underinvestment or limited resources, those gains are going to be harder to capture and benefit from, not only for you as an individual, but for your community as a whole, whether it be at a city level, at a county level, or at a state level. All right, y'all, I'm going to bring it home. We've talked about who wins, who misses out, and how that's shaped by race, geography, and business structure. In our final segment, we're going to cover what happens when these changes take effect, what could still be reversed, and what you can do right now to prepare and advocate for yourself. So stay tuned. You're not going to want to miss this. I will see you after the break. And don't forget to like and follow and subscribe on all of the social media platforms. Welcome back to the Do.Different.Better Show. I'm your host, Elaine Rasmussen, and we are in our final segment of this two-part review of President Trump Opportunity and Big Beautiful Bill for America, or as I like to call it, OBBB. We've unpacked the good, the bad, the ugly, and real world impacts. Now, let's talk about what happens next. Because knowing when changes take effect, what can still be reversed, and how you can take action is going to be the difference between reacting and flipping out and being ready. And I know you like to stay ready because that's why you're listening to the show. So, here are some effective dates that you actually really want to know. You might want to write them down. You might want to put them in your calendar so that you make sure that you have a good conversation with your tax preparer, even if that tax preparer is yourself. Okay, here's the timeline as it stands. Most tax rate changes and deduction extensions will take effect after December 31st, 2025. That means you've got about 2 years before the biggest income tax and small business changes hit. So they won't necessarily impact you for this tax year. So when you go and file your taxes next year, because I know you're going to file them on time and maybe even early, so you can get that money, that return, and invest it. This will not affect next year's tax returns for the most part. It will, though, impact your tax returns for 2026 and 2027 and beyond. Okay. So just know that that is going to be super important. Don't fret. Don't freak out. This is something. What you want to do now is start to understand what might be the things you need to put in place personally in your business or other aspects of your life. Maybe it's with your parents, maybe it's with your children, to be able to set yourself up and be ready for what's coming. So once again, I just talked about tipped people. You might want to start a business, right? Even if it's a side business and incorporate, because the expenses that you spend on your business could lower your tax implications. Or taking your tips and investing your tips could be another way to mitigate the taxes that you're going to pay on your tips or on your time and a half wages. Then there are the climate credit repeals, which are effective immediately upon enactment. So, if you've been counting on certain clean energy or economic vehicle credits, check the current status before you sign contracts or make purchases. That's not to say that you don't want to make those purchases. What I'm wanting you to understand is, if you are signing these purchases, understanding what might be the tax mitigating strategies or tax harvesting strategies you may need to implement to offset any benefits that you thought you were going to get that you are no longer going to receive. Those may impact you for this tax year or for upcoming tax years, especially as it relates to if you're leveraging depreciation or some other kinds of uh, credits or deductions. Individual enhancements, things like the expanded child tax credit and certain personal deductions, are set to expire at the end of 2029 unless Congress renews them, right? So once again, your personal taxes, that's not something maybe that you need to think about unless you have some of these other things that I've talked about that might impact you. But the tax credit, those tax credits are set to expire in 2029. Now, that doesn't mean that Congress could change their mind, but that's something that you want to understand and know as it relates to your personal financial structure and implications. So, here are some of the things that Congress can still change. Now, remember, no bill is truly set in stone, especially tax policy. A future Congress could reverse or amend certain provisions before they take effect. So, some parts, especially those with sunset clauses, will automatically expire if lawmakers don't take action on it. There are things like court challenges could delay or overturn specific sections, but this is why it is so important for you to have a good understanding, at the very least, what is your tax bracket. So when any of these policies shift, change, get amended, get expire, all you have to do is to put into Google, I'm in this particular tax bracket. How will this policy impact me? Right? So if you know your tax bracket, that's one of the most important things you can know. But the other thing that you want to know is, what is my financial trajectory? Am I on track to receive a raise? Am I on track to move? Are you anticipating moving to another state? Then you're going to want to understand how this might influence you in the state that you're moving to based on the job that you have or the industry sector that you are working in, or if you're thinking of expanding your small business into another state or moving your business to another state, at least its operations, that could be something that's important. So these are some of the structural things that you want to have a really clear understanding on. So then you can put these things into Google, Chat GPT, whatever your AI GPT of choices, and say, okay, these are all the things about me. How might some of these policies impact me, and what should I be aware of that I need to prepare for, right? But also, this is an opportunity for you to get in front of your policymakers, especially your state and city policymakers, more so the state. But whether you're talking to your representative, whether it's a congressperson or a state representative, a candidate at a town hall, or you're writing an email to your senator, here are some questions that I encourage you to ask. Number one, how will you ensure opportunity zone investments actually benefit existing residents? That's a critical one, right? Next, two, will you commit to protecting individual tax breaks for working families beyond 2029? Now, here's what we know. I don't remember what the exact number is, but the largest number of income earners are under that $200,000 in household income, right? So when we're talking about working families, remember I define working families as $150,000 of household income or less. So this is what we're talking about, and your state legislator should know that number, right? When we talk about working families, and if you want to be more specific and say, I am talking about people making less than $200,000 or $150,000. Be specific, because you want them to actually know who they're talking to, right? Number three, what's your plan to offset lost revenue without cutting essential services like education, healthcare, and public infrastructure? We've already seen our libraries come under attack. I don't know about you, but I'm a big fan of the library, love the library for a lot of different reasons. I hold meetings in libraries. I try to hold meetings in libraries whenever I possibly can. I love borrowing from the library. I love the services that the libraries provide. They are community centers, particularly for our seniors. They're social centers for our seniors and for children. So once again, you want to ask your local elected officials, like, how are you now with all of these tax cuts? How is money going to be found to pay for these other things? And how are you going to make sure that we're not going to see cuts to some of these key critical things that are actually crucial to the ongoing growth of this country: education, healthcare, and public infrastructure? Next, how will you maintain fair IRS enforcement so wealthy individuals and corporations pay their share, and are not that the audits are not disproportionately made to poorer people, poorer communities, lower income people who have the most to lose if they are audited and have penalties that they may not be able to pay for? So there are a lot of advocacy opportunities if this is something that you feel called to do. You don't have to be a policy expert to get involved. And I hope every single person finds a way, something that impacts them, for them to kind of get their backup about. But here's where your voice matters. pushing for equitable climate funding, especially if clean energy incentives are going to be rolled back. A lot of rural communities are benefiting from solar farms and other energy, alternative energy like ethanol, gas, things like that. So these rollbacks could actually negatively hurt rural communities that have found a revenue stream of being in the clean energy space, right? Demand sunset protections for individual tax breaks so they don't just vanish while corporate benefits actually stay locked in, right? And another thing is monitoring IRS enforcement rollbacks and push for fair audits across all income levels. But I want to just encourage you, as always, to really think locally, right? Talk to your city and state officials, your city councils, right? Help, and they actually have some influence into your state legislators, your state senate, your state House of Representatives, but also rolling up into your federal state congressional leaders that are in DC, right? Talk to your city and state leaders about how can they use federal funds to directly support the community, and or where there may be contract opportunities for local business to be able to be suppliers and be a part of growing the community. And because if those small businesses in your community can grow, then you know that your community can grow. It's just a natural evolution. So, what are some of the action steps that you can take? You know, I'm always going to give you something to do. I'm never going to let you leave without having some homework or an action step that every single person can take away. So, here are just a few that I want you to consider. And if you just take one, that will make me very happy. But also, tell me which step that you're going to take. I want to hear from you. So, don't forget to hit me up on AM 950, their YouTube channel, or hit me up on my channel at Do Different Better. But I want to hear, how are you taking all of this? What is important to you? What's valuable to you? What did you learn or what did you take away? But here are some action steps. Know your tax status. I can't say this enough. Talk to your CPA or use reputable tax calculators to see how the changes might affect you, right? Especially if you own a business, review your tax structure. Are you an LLC? Are you an S Corp? Or are you a sole proprietor? And see if the changes to the pass through deductions could actually benefit you or if you're not impacted at all. But this may also be the time when you change your tax structure. So maybe that you're a sole proprietor. Maybe now this is the time to become an LLC. Or once again, if you are doing a side hustle or a side gig, you're taking money on the side, maybe you're selling pies out of your house, this might be the time to legitimize your business so that you can actually take advantage of some of the tax benefits. There's a lot of money that you're leaving on the table if you're running a business out of your home, that if you're just trying to be like, well, I just want the cash. Okay, that might be great, but also what are you doing with the cash? Are you actually investing it in yourself? Are you investing it in your business? But there are benefits, there are tax benefits to making that investment in your business. If you bought a new mixer for those pies that you're making, if you bought a new table so that you can actually sell the pies at the farmer's market, those are all tax deductible to a certain extent, but you're not going to receive them if you haven't legitimized your business and actually registered your business with the state and gotten an EIN number, which, by the way, an EIN number is 100% free. Do not pay anybody to get you an EIN number. It is free 99. All you have to do is go to the irs.gov, type in the search bar, get EIN number, and in minutes, literally minutes, you can have an EIN number. Do not pay anybody to get you an EIN number. Next, I want you to track your credits and deductions, especially around energy, education, and small business deductions. This can be something simple as simple as a spreadsheet, right? And having on that spreadsheet, you can have like, hey, these are expenses, business expenses for my small business. These are expenses that I'm for my kid and their education or your own education if you're going back to school. And education is broad. So we're talking about any professional development. If you're learning a new skill, particularly going back into one of these industries that I talked about, that you're doing a transition in your life, a job occupation transition, these could be the opportunity for some of that to be deductible. Now, and just stay plugged in. Follow credible sources for updates because this stuff is going to change quickly and it may fall under the radar. And the best way to do that is to subscribe to subscribe to the AM 950 channel, subscribe to the Do Different Better channel on YouTube, and you can hear or on your favorite social media or Spotify or podcasts, Amazon podcasts. So definitely want to make sure that you stay in the know, right? So we have covered a lot. All right, y'all. That's the end of our part 2 of OBBB Deep Dive. We've covered what's in the bill, who it helps, who it leaves out, what you can do to prepare and push for policies that actually work for you, your family, your community, and your business. Now it's your turn. I want to hear from you. Do you see the OBBB as a win, a loss, or a mixed bag? Which part of the bill would impact you the most? And if you could change one thing about the bill, what would it be? Drop your thoughts into the comments on Instagram, LinkedIn, or YouTube. Don't forget to tag me at Do Better with Elaine or Do Different Better so I can see them. I'm going to be taking featuring some listener takes in a future episode. So definitely keep an eye out for that. And if you found this breakdown helpful, share it with your friends, your family, your coworkers, maybe your investment club, because I know you joined one because you listened to the show, or anyone who needs to know what's really going on in Washington and how this will impact you. This is the Do Different Better Show. I'm your host, Elaine Rasmussen. Stay brilliant, stay banked, and I will catch you on the flip side in the next episode. Thanks so much for listening.